Hello and welcome to a Complete Wealth special update. I'm Matt Battye. Today we thought we would have a bit of a chat about the topic, obviously, that's everywhere in the news at the moment, that is the coronavirus. And today I'm joined by Christopher Sutherland from our systems team. And Christopher, not being someone who works directly in the financial planning side of the business directly, is here to sort of give a bit more of a layman's approach to the discussion. So rather than just sort of talk about the same things you're probably seeing in the news, etc., we want to go a little bit in depth to some of the potential implications of what this particular crisis, as it's being described, might be about. So welcome, Christopher.
Thank you.
So let's start with, obviously, the big topic at the moment is share markets and investment markets and the impact that the coronavirus is likely to have on those markets. And I think, from that perspective, it's relatively straightforward as per a normal sort of market volatility event, whether it's a GFC or your Asian crisis or your tech wreck or any of the relatively large sort of market corrections. The thing with those corrections is they're a result of essentially the normal balance between those who spend the day trading in the market, who are normally buying and selling from each other and provide the vast majority of the volume in terms of trading. What happens is essentially the buyers desert from that part of the cohort, if you like, and so as a result we get an imbalance in prices and prices sort of start to drop. They're relatively common occurrences and most of the time they're relatively minor, and then every now and then we get these sort of more serious events, if you like, where we get these sort of major movements in sort of trading. Now sometimes they got really nothing to do with anything that's sort of particularly big or long term in the market or economies, and then sometimes they could potentially have very big implications, and the GFC being a good example of that. And other times they're a bit of a hybrid, and I think that's the sort of thing we're facing sort of at the moment. So we'll talk firstly a little bit about the coronavirus itself and not so much from the medical and infectious sort of scenario, but what sort of impact it might have, and is this a bit different? Is this something sort of new? And then we might sort of explore what impact that has on how we should behave, what difference does it make as investors? Is it really, all the cliches of is we just in it for the long term and should it be just a hold strategy, etc. And we'll explore those and we'll go into some of the questions people might be having in terms of that. So in terms of, the virus initially obviously was certainly sparked volatility, right? And markets sort of went a little bit crazy, and then we then started to see a range of responses from a geopolitical perspective. You had different sort of governments as this infection sort of started to potentially make its way around the world. And so initially, if we look at it from a pure sort of economic point of view, this is a bad cold, right? It's a bad flu. And so it's going to impact some areas of the economy a lot more than others, particularly obviously those with compromised immune systems, so definitely older people. But generally speaking, and as far as I understand, still isn't really a major concern for the vast majority of the population, and particularly the working population. But what has now occurred, and particularly occurred over the weekend, is we're now seeing increasing restrictions in terms of activity, and not just in terms of social activity, which is essentially what a lot of this stuff is targeting towards, but that's then having ramifications in terms of what is now economic activity with travel bans and groups not being able to get together, and a lot of organisations starting to close offices and starting to do meetings and those sorts of things. And that's where this gets a lot more interesting and a lot harder to predict in terms of what that impact is, because we're now seeing something that is clearly something with economic ramifications. We keep in mind that an economy is essentially based on the continual exchange of value between participants. So the more that happens, both the greater value created that's exchanged and also the velocity at which that value is exchanged. We'd measure that in terms of the money flow, if you like. That's what drives an economy, and the faster you can do that and the better you can do that, the faster your economy grows. And therefore anything that impacts that, anything that slows that down or creates a drag on it, that's what is a drag on your economy. So now sometimes you might see that in the parts of the economy that are officially measured or come out in certain things like GDP numbers, etc., and sometimes not so much. But and the effects are never sort of spread evenly across as well. Some areas will be massively impacted and some much less so, and some it will depend on the capacity to weather that storm. So there might be some parts of the economy that are in fact impacted much greater, but their capacity to withstand that is much more robust. And so companies and areas of the economy that are used to such volatility, will in their business models will normally be reasonably robust. Whereas businesses that are basically week to week, sort of customer to customer sort of survival with really thin margins, and particularly small businesses can be massively affected by that. So I guess the interesting thing about this particular event, if you like, is the fact that it's now most definitely having a significant impact in terms of the economy. So I guess the main question is, well, what does that mean? What does that mean from a short, medium, and sort of long-term scenario? And again, this in some respects is a bit unprecedented. We don't really have a model for this. It's not like we've been through a heap of these versions of this before. We've certainly been through market volatility before. We've certainly been through events that may have long-term ramifications. So we can use a few of those things sort of to give us a bit of an idea about how things might play out. The first one I'd point to is probably the most significant one, is the GFC, which is the most recent and most significant of these sort of events. And if I compare what's going on now with what happened in the GFC, even at the time that the GFC first sort of broke, I suppose, is a lot of people still don't realise what the GFC really was. They see, the economic downturn part of it, particularly in parts of Europe and places like that. They see the banking collapse in terms of the bailout sort of side of things. But what really was unprecedented in terms of the GFC is we actually had a freeze of the banking system. We actually had all the world's banks basically stopped interacting with each other. Now, fortunately, that didn't last very long. The Federal Reserve and ultimately other central banks stepped in and said, well, hang on a minute, we can't not have value being exchanged because otherwise you literally don't have an economy. So we'll step in and we'll make sure there's money available. And that sort of kick-started things and sort of kept things going. And they did that first rather than worry about, where do we have to prop up and what do we have to do and how do we fix the structure of this? And so the US, and one of the reasons why the US probably bounced out of the GFC a bit faster than, say, Europe did, is because the US did that immediately and then they went down the path of saying, okay, now let's fix it structurally. Yeah, we can have probably endless debates on did they do the right thing in sort of fixing it structurally, but they then went about rebuilding and recapitalising and building up the banking system. We didn't really face that much in Australia for a couple of reasons. One is our banking system was very robust and very well capitalised, in a very strong position in the first place. Second of all, our banks really didn't participate in the thing that blew up, in terms of the subprime lending and the right through from ninja loans and all those sorts of things. So there wasn't the same suffrage on their balance sheets as there was for a lot of the international banks, and they didn't do things like credit default swaps where they were essentially insuring other people's debt. So in Australia, it was reasonably short-lived, and we also were a massive beneficiary from things like a lot of the stimulus, particularly places like China did. Our mining companies, etc., were able to take advantage of the kind of government led drive to sort of continue to spark the economy. But because it was essentially a system collapse or a system under strain, then you did have something that needed to be rebuilt, and it did take actually quite a while for that to happen. So the GFC took, from an economic perspective, particularly some parts of Europe, it did take quite a long time for that to recover. Now, if I compare that to, say, this type of scenario, again, we're not talking about something that, as a disease itself, from all reports, has any major long-term impact. It's a bad flu. Everyone's probably going to get it at some point, and the people that are going to be affected by it are going to either be almost nothing and barely know they got it, right through to, it will be fatal for some people. Or it will be the thing that pushes over the edge. I mean, keeping in mind that one of the stats I saw recently is, last flu season, there was something like 4,000 people died of the flu. Now, they all didn't die of the flu, they died of complications like pneumonia and things that come about from compromised immune systems. But a lot of people die as a result of the flu being the thing that helps sort of push their immune system over the edge. And that's probably what's going to happen in relation to this particular virus, if it's anything like the degree of severity in terms of infection that's sort of being suggested. But if I look at that from a time frame perspective, then it's also the sort of thing that will disappear pretty quickly. So, and it's not, it's a bit like a bushfire. It doesn't come back again quickly. It comes back in another form later on, sort of thing. But it's not going to repeat the next week or the next month or whatever. So we're probably a flu season away at the longest from seeing the total impact of this from a social isolation, modification of behaviour perspective. But the bigger question is, what does it leave behind, from an economic perspective, and what businesses and what organisations aren't able to continue. We're seeing organisations like the National Rugby League, for example, here in Australia, say, look, we'll fall over if we don't have a season, or if we lose a big chunk of the season, we'll literally fall over. We don't have massive cash reserves. That's not how we operate. So we're in the business of showing rugby league, and if rugby league's not shown, we're out of business. And so there's going to be right down to the local cafe or child minding centre or whatever it may be that literally relies on traffic coming through the door. So that's probably the really big unknown, is that at the end of the day, economies are, there is that exchange of value, and that value ultimately comes from the deployment of human capital, as we call it, right? Is that our ideas and our efforts are deployed. We find a way to create value in the world for that, and that's what we exchange. That's where the money comes from, if you like. And provided we keep doing that and we keep making value to therefore be able to exchange it, then economies can work and they can grow. But if we don't do that, economies in reality are they're a made up concept, right? There's no natural economy that exists. It's the outcome of behaviours we all agree to participate in. And if we stop participating in those behaviours, then the all bets are off sort of scenario. So you could take the view of saying, okay, well, as a result of that, if everyone stops and is shut down and can't do it anymore and the economy's grind to a halt, then there is no money, then everything sort of falls over. You could extrapolate the behaviour to that, but the reality is human beings adapt and adjust, right? So, that you'll see things like, adaptations to behaviour. So, maybe this is a great time for streaming services. For example, everyone's locked at home and working from home. Maybe Netflix subscriptions go through the roof, or maybe Uber Eats, or there's lots of other areas of the economy that will benefit from the fact that you can't do international travel, but you're bored, so you'll rent a lot more movies, or you might participate in activities that are much more different to what you would normally do. So there'll be opportunities in different parts of the economy, as it's a bit like debt collectors, good businesses in recession. And there'll be areas that are hurt, travel, education sector, some of those things that are clearly going to be impacted quite substantially. So part of this is positioning for that and making sure certainly the investment managers that we use in our portfolios are already and had already been positioned for a lot of that, not necessarily in anticipation of this, but simply because that's actually an area of the market that has been significantly undervalued for quite some time as the market chased more growth-orientated, ideas-based, tech businesses and some of those sorts of things is where a lot of the market had been driven in the last couple of years. So a lot of our investments were already reasonably well positioned for a bit of a shock like this. Not for this particular shock per se, but at least in good defensive companies that are likely to continue to be able to develop and grow their earnings. So from that perspective, we're reasonably comfortable with where we're at from an investment portfolio perspective. We don't really know how much further the market might trade down. What tends to happen with these sort of drops is they trade down until all the blood's been let go. And what I mean by that is, again, most of the time in the market, you've got basically a bunch of traders trading with a bunch of traders. And real investors, people who are investing for the long term and the real stockholders in a company, are really not participants in the market on a day-to-day basis. And so you really got a bunch of traders trading with another bunch of traders. And so when you get these sort of downturns, a lot of the time, a lot of these guys are very heavily leveraged as well, right? They're trading their book and across commodities and shares and all sorts of different things. And so if they're caught out holding the wrong thing, normally what they'll do is they'll find something else in their book to trade off. So, my tech shares are taking a bath. So rather than add more volume to a falling market, what I'll do is I'll sell off my commodities exposure. I'll sell off copper, right? Because my copper futures haven't been hit yet because, that it started in tech, whatever it may be. And so I start selling those off, and that's why that sort of drops off. And then I might start selling my European stocks or, other things that are not yet taking the same degree of hit as the area that started. And as a result of that, I can sort of mitigate my losses. And sometimes, the market will bounce back out again and I'll be fine and I don't really have to worry about selling out at big losses in a portfolio. But where these things continue and they drop 10, 20, 30%, what you find is a lot of traders then get outside of their capability to cover that. And so, and of course, other traders know this. So those that have got out early or in a position where they have a little bit more backup, a little more capital behind them, they'll try and take advantage of that. And so it becomes this kind of like, survival of the fittest, sort of, or best prepared or luckiest, if you like. And so it's not until that really works its way through that you can be reasonably sure that the market's kind of bottomed. That everyone's too scared to sell too much now.
So who's been in the market so far, who's been participating so far? Would you say it's mostly traders? You talk about it's mostly traders.
It's always mostly traders, right? So if you look at any individual stock, the volume of any particular stock that trades on the market any day is actually surprisingly very, very small. It's a great question I like to ask people to get their sort of relativity, right? And if I said to you something like a stock like CBA, and if you look at CBA and say, okay, well, of the shares available in CBA, what percentage of shares trade every day? It's by the vast majority of trading days, it's less than 0.25% of 1%. So less than 0.25% of Commonwealth Bank shares are traded on any given day. The vast majority of time, about 2/3 of the time, it's that or less. In fact, it's literally over, if you take sort of 5,000 trading days, it's dozens of days that more than 1% is traded. Right now, CBA is a big company, not as big as it was last week, but it's a big company, so it's billions of dollars of CBAs being traded, but it's almost nothing of the total shareholder base. So when you see something that says, CBA investors did whatever they did today, bought up, sold off, whatever it is, generally 0.25% or less of the shares traded. And they weren't all single people trading. Most of those people had big chunks of shares. So the number of trades in a day in terms of the total shareholding is always very, very small. So, and that's because it's traders who are trading. It's not the average, share investor, be it a super fund or a mum and dad investor or whatever. They're topping up. They're adding bits and pieces. They're not trading their whole portfolio on a given day. Whereas, what I would call traders, those who are trying to profit from the movement in price in shares. If you're doing that, the velocity of trade is the biggest thing that matters. It's no different to, say, if you go down to David Jones, and David Jones, they trade T-shirts, right? They buy T-shirts in, they try and sell them for more than they bought them for. And how quickly they can do that and the margin at which they can do it, they're the two things that determine how successful they are as a business. So there's a degree of influence they have over margin. They can get their stock from cheaper places or whatever, but the velocity is really what drives the success of that business. So if they can keep trading T-shirts and selling them, replace them, selling them, replace them, selling them, replace them, then that's how they make money. And if they can't do that, they're not in the business of utilising the T-shirts, right? That's what the customers are there to do. They don't care about the value, the intrinsic value of the T-shirt, how nice it is, how good it feels, how warm a coat keeps you. They don't care about that. They just care about kind of turn it over. And the same thing is with anyone who trades things. And that's the share market is mostly on a day-to-day basis made up of those people. So they don't really care. They just need to buy and sell something. So if prices are dropping, then from a trading perspective, you want to sort of stay out of that as much as you can. You might be doing some short selling if you've got some particular positions, but that's very hard in a falling market. You're either really positioned for that or it's quite difficult. So what you're trying to do now is find what are your entry points, where you're going to try and put your money back, because you can't just sit on the sidelines. You've got to trade something. Now, it might not be stocks. You might be trading gold, or you might be trading oil futures, or all sorts of different things, but that's essentially what a trader's doing. They just see all markets as the different departments in David Jones. It's winter, so we're not selling T-shirts. Let's get over here and trade coats, sort of thing. So that's the activity that's always driving the market. And if you watch market depth, if you actually watch the share market and get on your broking account and watch your market depth, you'll see that phenomenon sort of going on. But when all the buyers disappear and switch onto the sell side or just sit there and wait, there's no one to take up that slack, because, again, investors, real investors, people who are just buying the company because they want the profits, they have what they have. And in these sorts of markets, it doesn't make any sense for an investor to sell something because they're still entitled to profit, right? So if an investor sells out of a stock today, say CBA, for example, then and it's not there when the dividend gets announced, then they don't get their profit. So from an investor's perspective, they're just worried about the long-term profitability. Now, if you really were worried about the long-term profitability of CBA because the share price has dropped, well, guess what? It's already dropped so much that it's now the profit's really got to drop a lot. You know, if it was okay value 30% ago, then the profit's got to drop by that too. Otherwise, it was too expensive and you'd already lost your money because you owned something that was too expensive. And that's going to be the case. That's always the case when corrections happen. People are caught holding companies that really weren't worth what they were, the price was at the time. And there's certainly been a lot of that in the market in the last few years. It's been driven by a very small part of the market. Has been most of the growth. So, but essentially everything else, if it was worth what it was worth from a intrinsic value, future potential profitability, unless you really think the impact of the coronavirus is going to systematically, kill that or make a big difference into that, then it's still worth pretty much what it was worth before that. Now, there's certainly going to be cases where that's going to be the case, right? If you were an exposed industry like travel or an education provider or, a cruise operator, right? So, and you don't have the capital behind you to weather that storm, or you don't have other business avenues, then yeah, absolutely, you go to the white, which is again one of the reasons why diversification is extremely important all the time, because you just don't know. Even if you have a reasonable degree of predictability in market volatility, which you could argue there's been for the last few years, that it's been very easy to foresee volatility in market because of that divergence between growth and valuations, if you like. It's the biggest it's ever been up until this recent sort of correction, but it had been very big for a decade. So you could be predicting that, that sort of divergent sort of collapsing, but it might do it slowly over the next decade. There's no causal mechanism that says it will definitely come back in a short, sharp way that you can profit from. So that's a mistake people often make. They see a divergence in Australian property market's a fantastic example, right? So people have been predicting the Australian residential property market's been overvalued, and it'd be very hard to argue on any measure that the Australian property market hasn't been massively overvalued for the best part of nearly 20 years. Okay. But if you went back, say, 15, 16 years ago and said, look, the property market is massively overvalued, I'm going to sell out of it and I'm going to stay out of it until it gets back to intrinsic value, it can continue to grow, as it has, for a whole host of reasons, and even get more overvalued. And even if that valuation gap is closed at some point in the future, it still might only come back to a price way higher than you got out. So it's the old Benjamin Graham saying of the market can remain irrational longer than you can stay solvent. So just because something's massively overvalued and is going to come back to a more reasonable value in time doesn't mean sitting on the sideline is the prudent way for that to happen. Does that make sense?
Yeah.
So and in the Australian property market, there's been some really famous bets in the Australian property market. And even when the rest of the world, their property markets collapsed and deflated substantially coming out of the GFC, and the Australian market did it, and there's all sorts of arguments about how we're different and special. We're not. Money's money, so it doesn't really matter. There's a bunch of factors that allow something to remain overvalued for an extended period of time. We have those conditions in Australia. Till a few weeks ago, I'd say they looked very set to continue, and therefore, we've always been of the view that as much as the market has been massively overvalued in residential property, we saw no major trigger of that deflating at any point in time. And again, markets are driven by the motivation of sellers, right? So for the market to deflate substantially in residential property, you need an event that triggers a massive sell-off, forced sellers, right? And we didn't really see that coming. It's foreseeable in the sense that, who knows, there's lots of things that can cause that. And even something like this particular crisis could be a trigger for that, right? If we did get into prolonged recession and the banks got under a lot of pressure and there was a lot of defaults and foreclosures on mortgage, there's your trigger. You could have a housing collapse as a result of that. That's definitely, I would say, even to the point of predictable, right? It's definitely foreseeable, but it's probably predictable. You could say it's very likely within the next 6 or 12 months you could start to see that happen. Okay. But is it actionable? Could you take advantage of that, right? And what's the risk of getting it wrong? So if you own a house, right, and it's your place where you live and you want to put a roof over your head, and you think trying to profit from the fall in property prices is a way to get ahead financially, and you get that wrong, and prices don't drop enough, or you blow it all on transaction costs, or you lose your job in the meantime anyway, or there's a whole heap of things that could happen to make the ability to execute on that profitably is by no means guaranteed, even if you get it right.
Yep.
Alternatively, you might find that, yes, there's a massive a problem in housing and valuation, sort of peel back 20, 30%. Property does that from time to time fairly resiliently because, again, as long as people aren't forced to sell, and roughly something like 40% of homes have mortgages. So, again, it's not the whole market. Banks themselves are extremely well capitalised in this country at the moment. They've probably never been in better shape to be able to withstand that type of increased defaults and those sorts of things. And they're also not going to be going out there and trying to actively drive the price of housing down because it's counterproductive to them, not from a default perspective, but also from a general lending and profitability point of view. So again, foreseeable, definitely foreseeable. It's been foreseeable for 15 years or more. Predictable, maybe. Maybe you could predict that would be a real term outcome if lots of small businesses go broke and there's lots of pressure in terms of that. And the government doesn't do enough in terms of stimulus to sort of ride that out. It's possible. Actionable, very, very rare. Very, very rare. You could get yourself in a position to actually profit from that. And it's an asymmetric risk, right? If you get it wrong, let alone all the personal impact you would have of trying to, move and rent and whatever else you're going to do in the meantime, especially if you've got a family, you really got to ring the bell, and you got your stamp duty costs and all your moving costs and all the stuff that comes with it. So it's not likely that people are going to be able to do that in a predictable way and actually make some money out of it.
So talk to me about what we should do as investors. What should we do in times like this?
Well, I guess the first thing is to really be clear about what you are, an investor, right? Because a lot of people regard themselves as investors, but because the bigger number is the market valuation as opposed to whatever dividends or cash flow I got last year or the earnings, the underlying companies or assets that I own, it's much easier to get caught up in the price movement. And in particular, what could I do to have predicted or participate, or is there a way I can and so one or two things tends to be the case is people say, how do I take advantage of this? What cash have I got? And so I throw that in the market. And if you're in a position where you were about to and you've been getting yourself ready to do so, then by all means, you should, if you were willing to invest 3 months ago, you should absolutely be willing to invest now. It's just 30% cheaper. So that shouldn't really change. Excuse me. But if you're already invested, which most investors normally are, investors are fully invested, they're there for the dividends, they're for the profitability, and they're not really worried about that sort of short-term market movement. But also, if you're drawing from your portfolio, if you're a retiree and therefore that engine is now providing cash flow to you, because there's no investment that pays a weekly wage or a fortnightly paycheck, right? So you always have to construct that cash flow in some way. Now you can do it by going and essentially buying products and paying someone to do it for you and cover that risk, or you can do essentially by having what we call our secure or stable pool, and we maintain a level of cash to try and to smooth out that timing. And now's the time to use that potentially. Like if this really is a major sort of economic event and dividends do get chopped a little bit, or the timing of things sort of break out or whatever, and we do get a bit of a downturn in cash flow in the next year or two, then that's what that cash is for. Or if alternatively your expenses go up because normal life happens, or let alone whether you subject to some medical event or something like that. So what we tend to find at this sort of period of time, and a lot of the calls I've been getting over the last few days, are people saying, look, I've always been sitting on this cash. You've always made me hold this cash. And when the market was going up, it was a bit annoying, but that's okay. I understood why I had it. Now that the market's down a bit, do I really need all this cash? Can I sort of throw some in? And let's look at the math of that and the risk of that, and we say, okay, well, what if let's say you've got $100,000 in cash that you probably won't need. Okay, let's say you've got that in your portfolio. And we say, and to have that, you'd probably have something around the vicinity of, say, $1 million in your portfolio if you those sorts of numbers to have that excess. So if you had $1 million invested and you've got 100,000 cash, and say, okay, well, what's the risk now? If I put that 100,000 in the market, let's say in the next 2 years the market doubles, fantastic. I'd take my 100, I'd double it. I've made 100,000. You beauty. Whereas if I leave that in cash for the next 2 years, I'll probably make almost nothing out of it, right? So I'll still have 100,000. But if I've got 100,000 cash and I've probably got somewhere around about $1 million invested in the market, that's now $2 million. Right. So I've got 2.1 that I've made. I've made 1.1 from where I sit today. Now again, that's just mark to market movements. You still need to look at what the real intrinsic value of that, etc. Well, that's not really going to fundamentally change. But in terms of did I make money in terms of price movements, you've made 100,000 on your 100,000, but you've also made $1 million on your $1 million. So there's no real risk there, right? There's no real downside to that. But you also didn't gain a lot, right? You gained an extra 100,000 when you already made $1 million. Whereas the alternative is actually quite different. So if you do need that 100,000, and it does accelerate the time where you now run out of cash, and maybe your cash flows from portfolios do tighten up a bit. You know, there is some cuts in dividends, or maybe there's continual economic shocks that we kind of don't see, and there is a major sort of scenario just at the time where your expenses really go up and you really do start to eat into that cash. And let's take that to an extreme. Let's say you now spend the whole 100,000. You do need it all. If the cash is there, it doesn't matter, right? Market recovers, your dividends come back, away you go, and life continues on. If not, and you've used up that 100,000 not there now, and we really do need it, and we now need to start selling. We're now selling those growth assets. We're selling our shares and property in a market that may have even dropped further, but certainly hasn't gone up yet, right? And so now we are selling off those units of growth assets. So every time we sell one of those, that's one dividend we don't get next year and the year after and the year after. And so the reverse compounding effect of that is what really does drive impact on long-term returns. And so you might find that essentially that 100,000 that you put in, you end up sort of selling that back to yourself for 70, in a worst case scenario. So not only have you lost that, but you then start eating into the rest of your portfolio as well. So the reason why I think it's really important to always maintain that insurance, if you like, rather than try and even take advantage of what can seem like an opportunity, is because you've got to look at what the life impact of those risks are, not the pure mathematical seeming financial. And that I would much rather a client sit there and go, yeah, I knew it was a good time to chuck that 100,000, then I'd have 2.1. That's fine. No problem. Life goes on merrily. But if you start down that slope of spending your capital down earlier than you would have otherwise wanted to, you really are sort of chopping down. So does that make sense?
Yeah. So earlier on you talked about, the velocity of money. And I know I've heard you talk about one man's expenditure is another person's income, right?
Yep.
So what about the role of government here?
Yeah, well, so there's two major sort of economic schools of thought, I suppose, in terms of this, and the Keynesians are basically of the view that when government's job is to do the work in the economy that's not being done by the private sector. Yeah, whether you subscribe to that view, wholly or partly, the government, there's no question that the government participates in the economy. Now, you could say that what the government does is remove excess capacity because everyone they employ, isn't doing something productive to create, because governments don't create value. Governments are they're more like the firefighter, to use a current sort of analogy, right? So they don't start the fire. They're not there to make you warm. They're there to make sure that you stay warm and you don't get your house burnt down, sort of thing, right? So they don't want to you don't want to put the fire out because the fire is good for you, right? But you don't want it to burn the house down. So government's role is more to sort of try and manage the things that are happening, as opposed to be the ones to create one. And people who like to suggest that governments do things, from the point of view of from a creation perspective, it's just a fundamental misunderstanding of how economics work. It's the voluntary exchange between individuals and the value that's created through that deployment of human capital, the ideas and efforts that creates value. That's not to say government doesn't have a really important role, but that's not their role. Their role is to make sure that there's balance and efficiency in that interaction, arguably. But human beings, Keynes himself sort of talked about this concept of animal spirits, right? Is that we don't always act in our own rational self-interest, right? And the advantage of let's call it the concept of a government or a non-emotional, non-animal spirit participant, which is the argument of what government should be in this situation, is should make up for. That's really what he meant. He meant when you're behaving like a human as opposed to a rational person, someone should step in and balance the equation. And that's really what that's I think, at least anyway, that's really what he meant by the government's role in those times, is to print money to ensure the money supply remains. Because the problem is, if that velocity doesn't continue, if there isn't that activity, then that is the economy, right? So it will ground to a halt. So in that situation, there's no such thing as government money, right? The government's spending our money, either the money they've already taken off us or the money they're going to take off us in the future. There's no such thing as government money, right? It's all our money. The question is, are we better off spending more of tomorrow's money today to keep things going so that there'll be more money tomorrow? Now, again, how well positioned are governments to do this? Some would say, if you look at the evidence, pretty poor, right? But there's a very strong argument to say there's no one else, right? So if the private sector, or the non-government sector, if you like, is behaving in an irrational way that's not in their self-interest, by definition, they can't fix it. So there would be an argument, or there is an argument at that point in time, to say, well, that's the role of government. But we need to be really careful about this and say, okay, we need to be really sure about, I think anyway, clear about what's happening. Like, it's not government money. There's no government handouts. There's no government pump priming. There's no government. It's our money being given back to us, right? Which means there's a bunch of services that they do that we won't get now. Or it's, if we do this for you now, there'll be more money that you'll have in the future because that value exchange has continued, doesn't ground to a halt. So provided you do that, and the GFC response provides some degree of confirmation of the potential value of that. If you compare the GFC response to the Great Depression in particular, the idea that keeping the money supply primed was of value is, I think, is reasonably... We can get too many credible arguments against that. Whether it was overdone, the way it was done, all those things we could debate. But there's very little evidence to suggest that was the wrong thing to do and was done badly. There's definitely plenty of evidence to say that's exactly what government got wrong in the 30s. But they learnt that lesson, I think, to a degree.
Right. And in terms of talking about what's going on in the shops recently.
So that's animal spirits, right? Well, not even. It's a whole other thing, right? So that's an example of where human beings tend to be, we're very rational, except when triggered. And we're triggered, fear is obviously by far our biggest trigger, and also we're much more rational in small groups. Crowds aren't just destructive because there's more volume and therefore ability to do work. Crowds are because they compound the worst in each other. So people always get a bit more bravado when they think they've got lots of support and power behind them, sort of thing. So crowds will always do things that individuals wouldn't do on their own. So, and that's we are seeing that, right? But that in itself does create a couple of very interesting things. First of all, it creates a very big disconnect in terms of the breakdown of societal interactions, right? So, we're all in it together, we're all here to help each other out and all that sort of stuff, as opposed to to me it's the other side of what I would call kind of the Wall Street phenomenon, right? Is this idea of saying that, look, what matters is what I have, and I just want to get the most amount of resource as possible. And whoever has the most resource is the best off, which certainly goes not against, but is not really the philosophy that we would subscribe to. And I'm yet to find a sustainably happy person who just had more resource is what made him happy. So I've never met that person, never even heard about them. So I don't subscribe to that view. But that idea that I might lose, that fear of loss, is really, really, really powerful. And then you get the secondary effect of that, and you see that I think it was you that was telling me about, the impact on Amazon and eBay and those sorts of places where people are saying, well, I'm going to hoard all this stuff and when the prices drop, then I'll sort of sell back.
Yep.
We're making a market to do that. There's an argument around that, but getting the price of oil up just so that you can make money, driving the price of something that actually has some utility and people use. Society they don't like that for obvious reasons, because you're not adding any value. You didn't create the gold, right? You didn't make the toilet paper, right? You're not the guy out there creating the value of the business. You're trying to, if anything, leverage off that guy's hard work, right? And you're trying to do that in a way that you're actually trying to take from someone else. So you've created no value, right? You're just a middleman. And so I think it's really good that, organisations like Amazon and eBay, etc., you look at their responses to some of this sort of gouging scenario and saying, look, we're not just going to have those people on our platform. Now, again, but if you look at that in terms of their rational self-interest, again, like all businesses, all businesses have a social license to operate, first and foremost, right? Regardless of whatever government regulation might be. If society doesn't agree that you get to exist, you just don't. If everyone decides they're not buying Mentos anymore, that's it, it's over, right? It doesn't matter how good the product is. For whatever reason, everyone's against it. Everyone pulls out, you don't exist. So, because you don't create value that people are willing to pay for. And I think from an Amazon sort of eBay perspective, they've obviously looked at that and said, look, at the end of the day, we want to be marketplaces and we want that interaction. And we don't want to reward behaviour that's counterproductive to that. And so I would argue that as much as it might seem like the right thing to do, and it clearly is the right thing to do, it's also, as is very often the case, the right thing to do is actually always in your self-interest as well. It might seem like it's not in the short term. And the same with these guys who are, hoarding toilet paper. It might seem like a good idea. But very few of them will make sustainable money, even if they can. Because they're not adding value. And the people in the world who grow and maintain wealth are people who generate value. There's no question about that. And
it can cause long-term impact on this too, right? So if we all buy toilet paper, for example.
Well, that's right. So it's an artificial stimulus. It's no different to the government coming out and saying we'll give you a subsidy for toilet paper, right? Because it's an artificial price mechanism, right? So it drives the price up. Now, what's going to happen to that? He's going to get a response, and it can be a really bad one. So you might find a genuine toilet paper manufacturer, I don't know, whoever makes toilet paper, right? Who gives a crap? Well, those guys have been going really well apparently. So. But there's lots of people who make toilet paper, right? So they're going to look at it and say, well, the shelves are, here's an opportunity for us to, our market's increased. It hasn't really. The consumption hasn't. This is no different to the oil price getting to $150 a barrel years ago, right? Back in the sort of GFC times, is the world consumption of oil didn't materially change. It was going up and it kept going up at the same sort of rate. It didn't materially change when the oil went from sort of $30 a barrel to $150. But the demand for oil futures went through the roof because traders were trading on peak oil and all these other sorts of rumours. They were buying the right to have them, no different to toilet paper. So you're getting all this hoarding of toilet paper. You then get this production response to say, let's get it all out there, let's sort of build it. Now, that creates potentially long-term input costs in terms of ramping up production and staff costs, and the margins will drop off too because there's overtime and there's all these extra. You have to incentivise everyone else to massively increase the ability to put toilet paper that was not there before. So it's actually very rare for companies to make a lot of money in these circumstances. They definitely don't end up making money where the end product's not actually being consumed. It's not like so things like hand sanitizer, that there's a potential for that money to be made there in the sense that people are using it.
Yeah, the consumption's gone up, right?
Yeah, 100%. So hand sanitizer is a good example, and there might be a response to that. Again, very dangerous. You might overcommit, overcapitalise, get ready for the short-term trend to try and make the money, and as a business, if you're not careful about what that does to you longer term in terms of the structural costs of running your business, you might find yourself in a situation where a year from now, when the sanitizer craze is gone, or 6 months, or even a week from now, if the sanitizer craze just disappears and people stop buying, then suddenly you've got all this production capacity of all this,
Yeah, it's not like software. It's a bit of lag and lead and lag time, right?
Yeah, 100%. So that's the danger. And so what you will potentially find is businesses that were arguably really well positioned for this crisis are the ones that end up going broke. And again, this is a sort of thing that our investment managers kind of look at when they look at what they would call an economic moat, for example. So, and management's response to certain things. So in some cases, prudent business managers will say, look, we're just not going to over-respond to this. It's not an opportunity for us because the consumption's not there. Or we're going to do it in a way that allows us to ramp up and ramp back. We can turn the dial, if you like. So that's the other danger potentially for sure. And then all of the people that run off the back of that, right, all the couriers and all the infrastructure and the shop assistants and all the people who think there's a huge demand as a result of something like that, and then that disappears as well.
Great.
So look, we've been going for a while now, so probably time to sort of wrap up. But again, the point of this, I suppose, was to sort of dive a little bit more into, I guess, some of the topics that probably aren't discussed into the same degree and the same sort of depth. So yes, look, this is there's a lot we don't know about this and how it's going to play out. There's a lot of uncertainty. But what is pretty clear, I think, is that human beings' behaviour is not going to fundamentally. It didn't change in GFC. It didn't change in the tech wreck. It didn't change any of those other times as well. And it's not going to change this time. So we are going to continue to start, interacting again and going through that thing. So in the meantime, I think the sort of thing you ask the question, what can people do? Is try and be as normal as possible. That's going to be super critical because there's, if you just walk around your local neighbourhood, there are going to be dozens, if not hundreds, of businesses that velocity of money, your expenses being their income, is going to have some material effect very, very rapidly. And so it's really important that we're all mindful of that, particularly, I think, at that sort of local level, because they're the people that are volunteering at the, for your kids' footy team and your cricket club and all those sorts of things. So if at these times we're not really focused on our communities kind of start to disappear, right? So, and that has very long impacts. That starts to impact the asset values of our properties, start to impact the, job opportunities for our children, and, can we grow our own incomes and those sort of things in the future. So that's the sort of thing we want to guard against. So absolutely, this is, this virus is a danger to, some vulnerable parts of of our society, and we should all take as much precaution as is sensible to limit that in particular. But we need to do it in a risk-adjusted way. We don't need to grind our lifestyles to a halt indefinitely on the basis of, people who already have compromised immune systems. That we've got to do the best we can to look after those people. But we need to do it in a way that's not, the cure isn't substantially worse than what we were trying to prevent. So you get out there and spend some money. That's probably the key. And as always, if anyone's got any questions, on this or any other topics, or anything you'd like us to discuss in more detail, then let us know. Thanks.